So gang, I'm still going over fundamental news. Like I said, this is attack. This is affecting the market. And we can see Euro USD going down to it's at 109 right now. We can see it going down to 108. As sellers can still push price down to 108, 107, 106. Like I said, gang, price hasn't been down here since the beginning of March, since March 17th, 2020, beginning of this pandemic. So we can see even Euro USD going down, and I'll keep you updated, with Euro USD, and we'll start breaking down Euro USD as well. As you know, we can trade with any pair, So I'll start breaking Euro USD down as well. I'm gonna start looking at Euro USD after that major move. So yeah, let's just go over this a little bit more. What's going on as far as inflation is concerned. They're going to talk about NFPs. NFP has to do with a non-formal payroll. That has to do with like unemployment rates and job rates. Because a lot of people are going back to work, so unemployment, like the job rates are going back up. At least 600, I think 600K, 608K people return back to work. Which is good for the US dollar, meaning that the US dollar, because we trade, Euro USD, Euro slash USD, we trade currency pairs in Forex. So we trade Euro versus USD. So since a lot of people are going back to work or gold slash USD. So we're trading gold over the US dollar or euro over the US dollar or Great Britain over the US dollar. Since a lot of people are going back to work, um, which is good, the dollar is about to rise back up. So when the dollar rises back up, we're trading one currency against another. So since this makes kind of sense since people are going back to work, you know, um, since the dollar is starting to go back up, we trade one currency against another. So when the dollar goes back up, euro is going to drop back down. We could see euro dropping back down to 108, 107 because people are going back to work. So we can see gold dropping back down next week. And gold probably is going to drop back down because of NFP payrolls and people going back to work. So we trade one currency against another. So when the dollar goes up, gold goes back down, euro goes back down, GPUSD will go back down. And when people are on unemployment and the euro and the dollar starts to go back down, the dollar is going back up right now. A lot of people just return back to work. But since if the dollar does go back down, we'll see gold head back up. We'll see Euro USD head back up, and we'll see GPUSD. We'll see all the pairs usually head back up because we trade one currency against another. So when we see the dollar usually going down, the other currency is going to go up, and when we see the dollar going back up, the other currency is going to go back down. So euro is going to go back down because the dollar is going back up. And they'll talk about this right now. I just want to give you a brief summary of what they're going to be talking about because they're going to be talking about NFPs and that have to do with payroll and with the USD, the dollar. As we trade one currency against another, as people go back to work, one currency goes back up. As the dollar goes back up, euro is going to go back down. Gold is going to go back down. So that's basically what's going to happen. That's basically what they're talking about. So I just wanted to keep you updated with that.
Meeting taking place as well, Tom, in Brussels, Belgium.
It's a 5-6 day trip for Secretary Blinken. He's doing a Kissinger act, going from country to country here around Eastern Europe amid this crisis. John, Euro Swissy. When does Swiss Bank intervene?
Euro dollar, a break of 110. 109 futures down by 0.8% from New York City. It is Payrolls Friday. It just doesn't feel like it. This is Bloomberg.
forecasts of both economists and also the Federal Reserve, where this year we will see nominal GDP decelerate from about 12% at the end of last year to something in the vicinity of 6% at the end of this year. That's a very sharp growth slowdown. Part of that's moderating inflation, but that is being expressed in the yield curve fundamentals.
That's a Chinese economy you just described. We're not China. What is normal nominal? What are we heading towards?
Well, we're not China, but we were a little bit Chinese last year because we had tremendous state intervention into the economy, trillions of dollars supporting economic growth, which are no longer there this year. So we're becoming un-Chinese in 2022. A more steady state long-term level for the U.S. economy would be something closer to about 4% nominal GDP, which would reflect 2% inflation-adjusted growth and 2% headline inflation. We'll be close to that in 2023 and probably arrive there in 2024. That will be kind of the Fed's longer-term objective. And if we're moving in that direction, then the Fed officials can take confidence that they're doing the right thing. They don't need to act more aggressively or change the pace. And just to step back to Lisa's point about the relevancy of payrolls to the Fed outlook, it's not impacting what happens on March 16th, but this does shape how the Fed is looking at action further out this year, maybe taking 50 bp rate hikes off the table at later meetings are no longer there this year. So we're becoming un-Chinese in 2020. Then the Fed officials can take confidence that they're doing the right thing. They don't need to act more aggressively or change the pace. And just to step back to Lisa's point about the relevancy of payrolls to the Fed outlook, it's not impacting what happens on March 16th, but this does shape how the Fed is looking at action further out this year, maybe taking 50 bp rate hikes off the table at later meetings. More importantly, we have a financial instability concern very prevalent in the markets in Europe and the US, and we have a Fed tool that potentially causes financial market instability as they unwind the balance sheet, and we don't fully understand the consequences of that unwind. So it may marginally impact the profile for the Fed funds rate. I think more materially, this may be pushing back the start and the pace of the balance sheet unwind, maybe even until after the Jackson Hole conference at the end of the summer.
Carl, monetary policy nuance doesn't read that well on a morning like this when people are trying to game out what's the meaning of $150 barrels of oil. When you take a look at a U.S. economy, what's the resiliency to some sort of broader military conflict? I mean, there are all sorts of scenarios that people are trying to game out. When just taking at commodity prices, what oil price could make you rethink that statement that we're not that close to a recession?
Well, $150 a barrel in oil would be about $5 gasoline in the U.S., so that would have shocking consequences to inflation expectations and the consumer spending profile, where we already see consumers starting. It was a strong retail sales report, as we last saw, but once we started to pry into the details, my colleague Yelena Shilecheva noted that this
idea that the market is short. But the second thing they're going to be watching over the weekend are these talks in Vienna, which looks like they may be reaching a conclusion. There's some optimism out there that we may get a deal that releases more crude. So as we go into the weekend, that's the balance that we're striking. But it's worth saying that the volatility is just off the charts. Overnight, when we had the attack on the Ukrainian power station, we went back to almost 120 before coming back all the way down to where we are now, 112.
Well, we had a boat sunk by mine or by attack. Reuters says maybe by mine. No one really knows. An Estonian boat, I believe, in Odessa yesterday. For the Russians, is the Black Sea delivery critical for them to move oil out to bring in revenue?
Absolutely. The port of Novorossiysk in the northeast Black Sea is one of the major outlets for Urals crude, their main export grade to the west. They need that to keep going, and it's important that ships can get to that port. And one of the problems that we've had over the last week is that a lot of tanker owners are unwilling to take their ships there because they believe it's dangerous, because they're scared of sanctions, because they the insurance is too expensive, or because they just don't want to do business with Russia. And it's very important to Russia that the Black Sea remains navigable.
Well, just talk us through the logistics and the time here. Let's say you send a tanker to pick up some of this crude. You pick it up, you leave the Black Sea. What happens if the sanctions come through? Is that what they're grappling with, that they get stuck with this Russian crude they can't do anything with?
Yeah, absolutely. And the other problem is you get to, oil's not sanctioned, but you get to Russia, you've got to pay port agents, you've got to do business. A lot of tanker owners, which may not have the biggest compliance